Welcome to Strategies for Reducing Your 2012 Tax Bill, including Hurricane Sandy relief. In this webinar, we're going to discuss the changing tax landscape for 2013 and cover tax strategies to reduce your 2012 tax bill. In addition, we're going to discuss some of the federal tax relief available in light of the devastation of Hurricane Sandy, which hit the New York, New Jersey area recently. My name is Vinay Navani. I'm a shareholder with Wilkin Guttenplan, and I'll be your moderator as well as one of the speakers today. So to begin, I'd like to introduce today's speakers. Brian Geissler is a principal at Wilkin Guttenplan. He joined the firm in 1997. Brian assists his clients with federal and state taxation, primarily focusing in the area of estate and trust and gift taxation. Lauren Landolfi is a supervisor at Wilkin Guttenplan. She joined us in 2007. She assists her clients in a variety of areas in tax planning and tax compliance, and she's a frequent speaker on tax updates. And my name is Vinay Navani. I'm a shareholder and director of tax at Wilkin Guttenplan. I help clients on a variety of different tax matters, including federal and state matters, as well as international tax matters as well. So with that, we're going to get started. And before we get started, I just want to make an introductory comment. You know, we hear so much about a physical cliff and what's going to happen to taxes, and we've kind of made a baseline assumption in this webinar that if Congress does nothing, we know what the law says the tax rates are going up. So we're kind of, when we talk about the future in 2013, we're working on that assumption that Congress, there will not be a compromise, and the law as it exists and will come into play 2013. Of course, that could change, but we're not going to know what those changes are until they actually happen. So just understand that as a background as we get into this later on in the presentation. And with that, Lauren is going to take over and start talking about some of the disaster relief available in this area.
Okay, so first we're going to start off with some Hurricane Sandy tax relief that's available to taxpayers in the New York, New Jersey area. So the first area that the IRS has come in and provided some relief is with regards to tax filing due dates. Tax filings that were due between October 26th or October 27th and January 31st of 2013 will be extended to February 1st of 2013. And this is going to impact both the filing and the payments. And whether the October 26th or 27th date affects you is going to depend on whether you're located. The 26th is our New Jersey taxpayers, and the 27th is going to be our New York and Connecticut taxpayers. Now, what is included in this relief is going to be any taxpayers that have a fourth quarter estimate due on January 15th of 2013. So if you have a federal fourth quarter estimate due on January 15th, we're going to get an extension for these taxpayers till February 1st of 2013. This will also impact taxpayers with a third or fourth quarter payroll tax return due during the relief period, or anybody that has any tax-exempt organizations. So our 990 filers will have an extension, or any fiscal year taxpayer that just happens to have a due date that falls between that relief period. Note the relief period for these January 31st due dates is just going to be one day, but anybody that falls in these relief provisions will have an extension. Now, who is an affected taxpayer? It's going to include taxpayer whose primary home or business is located within a federally declared disaster area, taxpayers whose tax professionals or whose books and records are located in these disaster areas, any relief workers that are coming to the area in our aid. Currently, federally declared disaster areas are going to include all New Jersey counties, and there are certain counties in New York and Connecticut that are federally declared disaster areas. As far as state relief goes, the state relief was very short-lived, and the windows have basically passed at this point. So your state tax returns are going to need to follow the regular due dates. So these filing and payment extensions that we just discussed, they only are going to apply to our federal tax returns and tax payments. All right, so the other area that the IRS has come in and given us some relief as far as this hurricane is going to be casualty losses. And this is not something new, but this is something that we just like to remind everyone that if you suffered a loss, you may be able to claim a deduction on your tax return. So a casualty loss must result from an event that is identifiable, it causes damage to property, and it's sudden, unexpected, or unusual in nature. Generally, a simple decline in property value is not going to meet the criteria of casualty. It has to actually cause damage to property. Now, the amount of the loss is calculated as either the lesser of the cost or the decrease in fair market value, which is typically measured as the repair cost. And then for individual taxpayers, we're going to have to apply two limitations, or we call them floors. So the first floor is the loss has to be reduced by $100, and then only the loss in excess of 10% of AGI is going to qualify as a deductible loss. It's important to note that these two floors were waived for Hurricanes Katrina, Rita, and Wilma. So far for Sandy, these floors have not been waived. There was legislation introduced just within the past couple days, and among all of the provisions, they are proposing that this floor be waived. But as of right now, this floor has not been waived. So keep your eye out, but for now it's in place. But now we're going to go through a quick example of how we put these floors into action. So we have a taxpayer who sustained $10,000 in hurricane damage in 2012. This taxpayer has AGI of $80,000. So first we need to take that $10,000 loss and reduce it by our first floor, which is just a $100 reduction. And then our second floor is to apply the AGI limitations. So we take our $80,000 in AGI at 10%, and our $9,900 minus $8,000 will get us to a deductible loss of $1,900. It's important to note that the loss has to be reduced by the amount of insurance reimbursement that is received. If the taxpayer, or if you have not received the reimbursement at the time of filing the return, then we have to use some estimation of what that insurance reimbursement is. If you have a casualty loss and your actual reimbursement is less than expected, then the additional loss can be claimed in a subsequent year. It's important to note that the two floors will need to be reapplied in the subsequent year as well. So this is really not a great answer because we have these AGI and reduction in loss limitations we have to get over twice now. The other alternative is if the insurance reimbursement that you actually receive is more than anticipated, then the additional amount has to be recaptured and included into income in the subsequent year. Now, when do we claim these losses? Typically, a casualty loss is claimed on the tax return for the year of the loss, regardless of when the damaged property is repaired or replaced. So for our 2012 losses, these are going to be tax returns filed in April of 2013. The exception occurs when there is a federally declared disaster area. These losses can be claimed on a prior year amended return. So for taxpayers that have losses suffered as a result of Hurricane Sandy, we'll be able to amend our 2011 return and claim that casualty loss on the 2011 or 2012 return.
So, Laura, let me just add a point here. So if I have a casualty loss in 2012 and I have a significant change in my income between 2011 and 2012, that may help decide which year I go back and claim this return on, because that 10% of income floor will be that much less, and I'll get more of a tax benefit from claiming the casualty in that year, right?
Absolutely. Yep. We need to really pay attention to our taxpayers, and sometimes we really can plan to see what year we're going to get the biggest benefit for these casualty losses. Okay, good. Great. As far as casualty losses for businesses, if property used in trade or business is totally destroyed by a casualty loss, or by a casualty, the amount of the loss before any reductions for insurance premiums or proceeds is going to be the adjusted basis of the property, even though the fair market value of the property may have been less than that amount. Now, how do we substantiate these losses? We have to show the IRS that we sustained the loss, and they're going to ask that we prove that loss upon audit. It's not enough to just show that damage did occur to property. So we're going to need good descriptions and locations of what property was damaged, and we have to be able to prove adjusted basis upon audit. So how do we do that? We can show an original purchase contract. Obviously, we can go back and show what depreciation has been claimed in the past. And the other good thing when we're dealing with really big losses in particular is to have an appraisal done immediately before the loss. That way there's no question in the IRS's eyes. And a couple special rules regarding disaster losses. A taxpayer that's located in a federally declared disaster area that receives disaster payments for the cost of repairing or rehabilitating their primary residence, which is typically going to be our FEMA payments, these payments are not going to be considered taxable income for these taxpayers. Now, the same doesn't hold true for businesses. If businesses are receiving payments for disaster assistance from the government, they will not be able to exclude that income from gross income. So there's a little distinction whether these payments are received by individuals or businesses. All right, so.
And I think we have a polling question right now, Lauren, right?
Yes, we do.
Okay.
So you'll see the polling question come up on your screen. To substantiate a casualty loss, you should have the IRS call your insurance agent, obtain an appraisal that shows the value immediately before the loss. You don't need substantiation. You should ask your accountant to estimate the loss, or none of the above. And we'll give you guys a couple seconds to go ahead and answer that question.
But again, it is important that you respond to the question if you're trying to get CPE credits.
And give you another couple seconds to wrap those up. Okay, so to substantiate a casualty loss, we're going to have to get an appraisal. Again, in the case of these large losses, that's going to be the best way to substantiate. So now we've kind of discussed what has happened as far as Hurricane Sandy relief that's been released, and we're going to move into more the planning section of our program today. So first, we're going to start off with some tax planning for individuals. So most importantly, we have 3 very important rules of tax planning. And the first, we want to stay out of jail. Next, we're going to pay as little tax as possible. And finally, we want to pay our taxes as late as possible. So how do we do that? Our traditional tax planning has always been to defer income while accelerating deductions. As we go through the presentation a little later, you'll see we may be changing that methodology a bit, but again, we'll circle back to that in a bit. So first, a quick overview of our taxing system. So we have a regular tax system and an alternative minimum tax system, or AMT. And AMT is basically a parallel taxing system. And you'll notice that certain items of income are taxable for alternative minimum taxable purposes, but not for regular tax purposes. You'll also note that there are certain deductions that are allowed for regular tax purposes that are disallowed for all min tax purposes. And what we get to is what could be a potentially very large spread between regular taxable income and alternative minimum taxable income for the same taxpayer. And we'll talk about what items of income and deductions aren't allowed in a minute. And the other thing to note is that our regular tax system is going to be a graduated tax rate, while our alternative minimum taxable system is going to be at a flat rate. So between the differences in income and deductions and then just the differences in tax rates in general, you'll notice that our tax owed for a regular tax is substantially less than the alternative minimum tax liability. And unfortunately, the taxpayer is going to have to pay the higher of the two. So in this case, this taxpayer really has a big impact when we take into this alternative minimum into account. So what are we talking about differences-wise? Income that's subject to alternative minimum tax but not subject to regular tax is going to include incentive stock options and certain tax-exempt interest, private activity bonds. Deductions that are not allowed for AMT but allowed for regular tax are going to include state taxes. In the New York and New Jersey, Connecticut area, obviously real estate taxes, income taxes, they're so high that this is a big issue for taxpayers in this area. They're frequently going to be in AMT because these state taxes, they're just disallowed completely as a deduction for AMT purposes. The other thing is going to be home equity interest. If the interest in the loan wasn't used to improve your residence or purchase your residence, this will be disallowed for alternative minimum tax purposes. There's also some business depreciation differences in the calculation of depreciation that will give rise to some deductions disallowed for AMT purposes.
So, Lauren, if I'm understanding you, if I go out and get a home equity loan and I use it to buy a new car, is the interest deductible or is it not?
Not deductible for AMT purposes.
Okay.
Okay, so now we'll talk a little bit about some specific tax planning strategies. So if you have a taxpayer that has a net realized capital gain and unrealized losses, we might want to consider selling these losers to offset the gains. It is important to note that there are wash sale rules, so you can't sell a stock and buy it back until there's this 31-day waiting period that's passed. If you do repurchase the stock before that 31-day waiting period has passed, the wash sale rules will come into play and the loss will be disallowed. The good thing about selling these losers to reduce your capital gains and kind of shelter some of that income is there's New Jersey benefit as well. I'm sure many of our New Jersey taxpayers know New Jersey doesn't allow for any carryovers at all. So we may have a capital loss carryover for federal purposes. That's not going to help us in any way as far as New Jersey goes. IRAs. In 2012, the contribution limits are $5,000 per person, and they are $6,000. There's a $1,000 catch-up for contributions for taxpayers that are 50 years or older, and these contributions must be made by April 15th of 2013. So what type of IRAs are we talking about? We have a traditional deductible, a traditional non-deductible, or a Roth IRA. So our traditional deductible IRA, this allows us to get a deduction today, and we pay tax on the distribution and the earnings when the monies are distributed from the IRA. For taxpayers that are covered by an employer retirement plan, this is not going to be available to them if they're married and their AGI is over $112,000. If the taxpayer is not covered by an employer retirement plan, then the deduction is allowed regardless of the AGI of the taxpayer.
So, Lauren, when you say AGI, what are you referring to?
Sorry, I'm referring to adjusted gross income. So this is a measure on the tax return that's going to come into play a lot of times when we're talking about limitations on benefits available to taxpayers.
And that's income before deductions, right?
Correct.
Okay.
So traditional non-deductible IRAs, these you don't get a deduction today, and you pay tax on the increase in value when distributed. Now you might be asking yourself, well, if I don't get a deduction today, why does this benefit me? Well, what it does is it's a tax-deferred transaction. So you put the money into the IRA today, and yes, you don't get a deduction today, but the money sits in the IRA and grows and has interest income and generates income over the life of the IRA. You don't have to pay tax on that interest while it's earning in the IRA. You don't pay tax until it's just actually distributed from the IRA. So basically, it's just a great way to defer tax. The important things with these traditional non-deductible IRAs is that it's very important that we track contributions are the basis within this IRA to prevent double taxation. Because we've already paid tax when we made the contribution into the account, we want to account for that when it comes out. We don't want to pay tax on that contribution twice. So how do we track basis? We generally do it with this Form 8606. It's very important to file this every year with your tax return. That way you keep track of what your basis is in the IRA, and the IRS also has a record of it. The last IRA we're going to discuss are going to be our Roth IRAs. So this type of IRA gives you no deduction now, and you pay no tax on the distribution in the future. The really nice thing about this IRA is that the money grows over the life of the IRA, and when you actually take the money out of the IRA, you pay no tax on the contributions or the earnings, which could be a really great situation for some taxpayers. Now, whether the Roth is best, it's really based on personal circumstances. There's a lot of complicated tax software out there available to us that goes through some very, very big computations of who these Roths are good for. But it's something definitely to talk to your tax advisor or talk to us about. For married filing joint taxpayers, when the AGI is phased out, between $173,000 and $183,000. So taxpayers, once they have AGI over $183,000, these Roth IRA contributions are not going to be allowed. And again, the great thing about these is the earnings are completely tax-free. So what a lot of our taxpayers have been doing is they've been converting to a Roth IRA. So we convert what was a traditional IRA, either deductible or non-deductible, to a Roth IRA. And in the year of the conversion, that conversion is considered a taxable distribution from a traditional IRA. Whether to convert these IRAs, it's really a complex analysis. But a lot of people are finding this to be a great benefit today because market values are so low and income for a lot of people has been low. So it allows people to get these monies out of a traditional IRA while tax rates are low and while their income, their personal income is low. All right, so next we're going to move into how to avoid estimated tax penalties, something nobody likes to have to pay. So the IRS wants us to pay our taxes as we earn money. So they want us to pay our taxes in evenly throughout the year and not wait until April 15th of every year to write a check. So how do we do that? We either pay our tax through withholding or estimated tax payments. So withholding is going to be, your W-2 employees. They have these taxes withheld from their paychecks, and other taxpayers make these payments quarterly through vouchers, estimated tax vouchers. Now we have a couple exceptions of how we get out of paying tax penalties. So we either pay our estimated taxes based on a prior year liability, or we use an annualization method. So for our taxpayers that are paying quarterly vouchers, we can ask these taxpayers, how did you earn income during the year? If there was a large transaction during the fourth quarter, obviously these taxpayers aren't going to want to pay the large tax until they've actually earned the income. So we can kind of match our income to our tax payments, and we call it annualizing. The nice thing about withholding is treated as earned evenly throughout the year. So these taxpayers that are W-2 taxpayers, if they need to get in some extra tax payments at the end of the year, a nice thing to do is really accelerate these withholdings on a year-end bonus, which now is a great time to be doing that. If you need to get some extra monies in, just withhold these taxes from your bonus, and these taxes will be considered as paid evenly throughout the year. So some thresholds for what gets you out of paying these penalties. First, we're going to calculate our projected 2012 tax liability, and then we're going to calculate what our expected 2012 tax withholdings are. If your withholding is 90% of your expected 2012 tax liability, then you've paid it enough during the year. We don't have any penalties to worry about. The other thing to do is look at the safe harbor and look at the prior year. If the withholding is greater than 100% of the prior year tax liability, then we're not going to have a penalty. It's very important to note that for some taxpayers, and these are going to be our higher income taxpayers, that 100% floor is actually going to be 110%. So taxpayers that are higher income, they need to pay in 110% of their 2011 tax liability to avoid estimated tax penalties for 2012. And whether we use this 90% or 100%, 110% floor is really going to depend on taxpayer circumstances and income, and it's something that we're doing a lot of planning with now as far as our clients go to make sure we avoid any penalties. So last, as far as individual deductions, we're going to talk about some itemized deductions available to taxpayers. So we have our medical deductions, our state taxes, interest, charitable contributions, and some other miscellaneous deductions we'll talk about. So medical expenses have to exceed 7.5% of AGI to get a marginal benefit. So if you have a taxpayer that has substantial medical expenses, only the expenses in excess of 7.5% of AGI, 7.5% of AGI are going to qualify as a deduction. So obviously taxpayers really need to have substantial expenses or low income to see any kind of benefit for this deduction. So what can we do? How can we plan around this? A good thing to do is consider bunching deductions in the current year or the succeeding year to reach a threshold. to kind of group all your medical expenses together in one tax year so you can really elevate that medical expense total, thereby really increasing the potential refund or potential deduction. Now, the one thing to note is that self-employed taxpayers don't have this same 7.5% floor test. They get 100% deduction for their health insurance right on page 1 of their tax return. Now, this is actually one area that New Jersey is a little more favorable than our federal rules. For New Jersey, that income threshold is much lower. It's a 2% floor, so medical expenses in excess of 2% of New Jersey income will be allowed as a deduction for your New Jersey income purposes. So frequently what we see is we'll have a taxpayer that has a W-2, and there's a disconnect between what federal wages are and what New Jersey wages are. And a lot of times the taxpayer will have income, health insurance premiums that are not taxable for federal purposes, but they are taxable for New Jersey purposes. So what we like to do is reconcile the difference between this New Jersey wages and federal wages, and any of those differences that relate to health insurance premiums, they will be allowed as a deduction for New Jersey tax purposes. Okay, next we'll talk about some state taxes. So real estate taxes and New Jersey or any other state income taxes that are paid in 2012 are allowed as a deduction for federal purposes. This is where we're going to consider all taxpayers basically on a cash basis. We are only concerned with tax payments that are made during the 2012 calendar year. It doesn't matter what year that actual tax payments relates to. So an example of what I mean, if you have a 2011 tax return with a New Jersey tax that was due on April 15th of 2012 and paid on April 15th of 2012, that's going to be a 2012 deduction. So one thing our clients are always asking us is, should you prepay your state taxes? And the answer is going to be probably not. And why is that? Again, this is going to be because of AMT. Under our AMT system, state taxes are not deductible. So this is really going to impact taxpayers that have significant state tax payments, which is what I'm sure many of you on the call are used to, common for us New Jersey, New York residents. So the only way to determine whether you should really prepay the estate taxes is going to do a tax projection and plan. Talk to your tax advisor and have us do a tax projection for you and see if it makes sense to prepay those state taxes or if it makes sense to just hold off and not pay that tax payment, which isn't due until January 15th. Something that everyone can do today as far as tax planning goes is charitable contributions. Make your year-end contributions by the end of the year for a 2012 deduction. A nice rule refers to credit cards. As long as you make that charitable contribution by December 31st, it doesn't matter when the actual credit card bill is paid. So if you pay that credit card bill in 2013, it's really going to be irrelevant. As long as the charge is made by December 31st, it's going to be a 2012 tax deduction. And it's very important that we keep track of our substantiation rules and make sure you really track these contributions. The IRS is really hot on this issue right now. So if you're going to claim a deduction, make sure you can substantiate that deduction. In addition to giving cash, we can also give securities. If you are holding stock that is appreciated and held for long term and you'd like to donate that directly to charity, this is a situation when we're going to have the taxpayer transfer the security directly to the charity. What this does is the taxpayer will avoid paying the gain, and this taxpayer will get a fair market value deduction for the charitable contribution. So kind of a best of both worlds scenario. Now, if the stock is depreciated, what you should really do is sell the security first and then transfer the cash to the charity. What this allows you to do is you get the benefit of the loss and you get a charitable deduction for the amount of the contribution. So if you're going to give security, just really pay attention to whether you have a gain or loss on that security. Another area as far as charitable contributions, we have these donor advised funds. These are really great. It's a vehicle to get a tax benefit of a charitable deduction today and pay amounts out to the charities over future years. What these are they're 501c3 organizations. They're usually set up with an investment advisor, so we've given the example of Fidelity and Merrill Lynch. And in the year that you make the contribution to the donor-advised fund, you get the tax deduction in that year. And then the donor-advised funds goes ahead and listens to your recommendations, and they make distributions out and contributions out to these 501c3 organizations over the next several years. Usually there's no limit on a time limit on how these contributions have to get out. And we use these in years where taxpayers have unusually high income years. So this allows them to get a really huge charitable deduction in a year that they have unusually high income, but they really spread the benefit of their charitableness over several years. And these have substantially lower fees than private foundations, which is why they're really good for taxpayers that are kind of in a one-year high-income situation. So some other miscellaneous itemized deductions we can talk about. Tax preparation fees, so the fee you pay to have your tax return done is a miscellaneous itemized deduction. Investment advice or investment fees. Any unreimbursed employee business expenses that are incurred. These have a 2% AGI floor, so only the expenses in excess of 2% of AGI are going to qualify for a deduction. And this is another area where we're going to consider bunching our deductions in the current year to really get a maximum benefit. So get all these deductions front-loaded in 1 year to see a benefit. Unfortunately, these deductions are not allowed under the AMT taxing system. So if you have a taxpayer that's in the alternative minimum tax, these really aren't going to provide a benefit. All right, so I think we're going to go into another polling question. The following is miscellaneous itemized deductions subject to the 2% AGI floor. So either our tax prep fees, investment expenses, unreimbursed employee business expenses, or none of the above, or A, B, and C. We'll give you a couple seconds to answer that question. And then this is just a reminder to please use the question box in your GoToWebinar panel if you have any questions. And also remember that contact information and copies of the presentation will be able to be obtained after the close of the webinar by sending an email to us at info@wgcpas.com. All right, and just another second for everyone.
Okay, and of course the answer is A, B, and C. All of those items are miscellaneous itemized deductions subject to the 2% floor. So let's talk about a few minutes about business tax planning. The biggest item that we have, when a business incurs money for fixed assets, usual concept of depreciation is you may spend $1,000 when you purchase the equipment, but for tax purposes, we generally spread that out over a period of time that's based on IRS tables. A computer, for example, might be 5 years. And so wouldn't it be great if the businesses, they're out of cash in year one, they don't get the full tax write-off for many years. So one of the things that's kind of been in the congressional toolkit for the past 10 years is accelerating that depreciation benefit so that the depreciation of the tax benefit is more closely aligned to the cash that the business spends. So what we have right now in the year 2012 is a concept called bonus depreciation. We've had bonus depreciations in different flavors for many years. In 2012, effectively a business can write off 50% of the cost of property purchased in 2012. So if I go out and buy a $50,000 server in 2012 and I meet some of the other rules we're going to talk about in a moment, up to $25,000 of that can be immediately expensed, and then I'm still going to get some more depreciation. I'm going to claim my regular depreciation that I would be entitled to on the remaining $25,000. So what's going to qualify for that? Most machinery equipment, most computer software, and certain types of leasehold improvements. Now the key to getting this benefit is the property has to be placed in service by December 31st, 2012. It's not good enough if I just order my computer online by December 31st, 2012. It's got to be received, running, used in the business by the end of the year to take advantage of the bonus depreciation. The other key thing for bonus depreciation is that it's only available for new equipment. Okay, if I purchase used equipment, that's not eligible for bonus depreciation. And bonus depreciation under current law is expiring at the end of 2012. So there's no limitations on the size of the business or the amount of assets you can buy. Bonus depreciation helps a small IT company as well as it helps a humongous, public utility. Okay, so it's a wonderful tool out there. Now, the alternative to 179, which is also a section that's been around the tax code for a long time, is known as Section 179 expensing. And it allows a full expense of the amount you spend on the equipment, but there is a limitation. The limitation is that in 2012, you can't use it for more than $139,000 of fixed asset purchases. And if you spend more than, I don't have it in the slides, but approximately $560,000 or so of fixed assets, then even the 139 is not available. So it's really aimed at smaller taxpayers. It's not aimed at the public utilities. It does help work with used equipment. Let me go back a slide. It does work with used equipment and things that would otherwise not qualify for bonus. So without getting into all the details, this is another tool in your toolkit for recovering the cost of machinery used in the business. Now let's talk about automobiles. The tax code doesn't favor, well, let's say it in the positive. The tax code favors automobile leasing. It doesn't favor automobile purchases because under the usual limitations associated with automobiles, your depreciation deduction in any year is about $3,000. So I could buy a $20,000 car and get a $3,000 deduction, or I could buy a $100,000 car and get the same $3,000 deduction. So there's a lot of limitations there. As part of that 50% bonus we spoke about a minute ago, that first year deduction is increased for 2012 from $3,000 a year to $11,000 a year. But usually what will happen is if all things being equal, many businesses will find leasing a car will get more of a tax benefit than actually purchasing a car. Now, there is this loophole, some people call it, for the heavy SUVs. If a car has a gross vehicle weight of over 6,000 pounds, those limits we spoke about in the previous slide don't apply. And what you'll find is those are going to be the really big SUVs, the large Land Rovers, the large Lexus or Suburbans, those types of cars. And if the car qualifies for this criteria, believe me, the dealer will let you know because that's a big selling point to them. And if that's the case, then 50% of the cost of the car is deductible in the year of purchase. Now, whether you're talking about a regular car or a large SUV, there's some commonalities here. The automobile has to be a new car to take advantage of these benefits. And the dollar amounts we've been talking about are all based on 100% business use. Okay? The way the IRS looks at it, driving from your home to your office, where one leg of that segment is your home, almost always is considered commuting and therefore is considered a personal mile. So you have to really watch out. Many business owners think that they have a very high business use, but in reality their business use is really much lower. When you take out the mileage from their home to their office, it's really once they get to the office and they make their subsequent trips to see clients, to go to work sites, for business meetings, things like that, those tend to be better business miles. And to get these benefits, you have to use it more than 50% in the business. The other big area is business retirement plans. Now, Lauren spoke about IRAs, which are really individually focused. There's a number of different business retirement plans that are available to businesses, and the concept is the business gets a tax deduction today, the employee does not recognize income until retirement. So it's a very powerful tool. The main hurdle or threshold to a retirement plan is almost all the retirement plans have a discrimination concept, meaning that the owners and highly compensated people can't have funds put in for their behalf and not for the rest of rank and file employees. And there's a number of pretty complicated mathematical tests, and different types of plans have more restrictive tests than others, but there's going to be some contribution, whether it be a voluntary contribution by the lower level employees or as a contribution by the employer to the rank and file, to enable the owners and highly compensated employees to put as much away on a pre-tax basis as they would like. So think about that. One of the great aspects of retirement plans is even if I'm report my taxes on a cash basis, a retirement plan is really one of the only items that can be funded after the fact by the due date of the return. So for example, my 2012 business return will likely be due on September 15th, 2013. I don't have to fund my 2012 pension contribution until September 15th, 2013, and I can still get a tax deduction. Now, most of the types of plans have to be created and in place by the end of the year, but they don't necessarily have to be funded. And there's even some flexibility with that on more simplified plans such as SEPs or simplified employee pensions. So I would encourage you to look at that, especially if you're a closely held business, you don't have many employees. It's often a great tool. The last item I'm going to speak to on the business side is corporate dividends. We're going to speak a lot in a minute or two about the increase in dividend tax rates from 15% to regular ordinary rates. But if I have a closely held business and I have money accumulated in a C corporation and even some S corporations that have, if I take them out, I'm going to pay tax, this is an opportunity to take them out at a relatively low tax rate. Another item that sometimes we see with closely held businesses is owners will take out money, and when they take it out, they really mean for it to be a loan. They choose not to pay tax on it because the intention is to repay it. It's shown on the balance sheet for a loan. Year after year goes by, and the owners never get around to writing that check back to the company. So this may be an opportunity to say, you know, our intentions have changed. We were originally going to take this as a loan and pay it back, but now we think that it's best to just treat it as a distribution. And now you would treat that as a 2012 distribution, and as a dividend it would be taxed at a 15% rate. That 15% rate is going to be going away at the end of this year, so that is something, especially for closely held businesses, to think about. So now we go to a polling question. 2012 taxpayers may deduct bonus depreciation for what percentage of qualifying assets? 50%, 100%, 0%, 20%, or none of the above. So if you just take a minute and answer the question, we'll keep things moving. And hopefully this is an easy question. We'll wait just a few more seconds. Okay, and of course the answer is 50% bonus depreciation. Okay, so now we're going to go and talk about the individual side of things and with the changing tax landscape.
Okay, so I'm sure everyone has been hearing on the news, and it's really a hot topic today, what's about to happen in 2013. So this may or not be news to you, but basically taxes are going up. We're going to see tax rate increases across the board. So regular tax rate, capital gains rates, Medicare, payroll, and estate and gift tax rates. Everything's going up. The Supreme Court upheld the Affordable Care Act based on the power of Congress to tax, and Obama was elected again. So the new Medicare taxes that were created under this act will be coming into play in 2013. So the new Medicare tax is a two-pronged tax on both earned income and unearned income. The additional Medicare tax on earned income is going to be 0.9% of tax on wages and self-employment earnings in excess of certain thresholds. So these thresholds are $250,000 for married filing joint taxpayers, $125,000 for married filing separate taxpayers, $200,000 for any other filing status, which is going to include our single, head of household, or widowers. Employers are not required to consider the spouse's earnings when they're withholding for these taxpayers. So the example I like to use is a taxpayer and a spouse both earning $170,000 each individually are not going to be subject to this 0.9% tax increase. So their employers will not be withholding for these amounts. But clearly when you put their earnings together, they're going to absolutely be liable for this tax. So it's important that the taxpayers really be aware if they're going to be subject to this additional tax. And in many cases, we may need to have taxpayers make estimated tax payments to cover for this potential shortfall. The Medicare tax on unearned income is it's going to be a tax on investment income, and it applies to individuals, estates, and trusts. The tax is going to be 3.8% of the lesser of either net investment income or the excess of modified adjusted gross income for such taxable year over a threshold amount. And we're going to talk about this in an example in just a couple minutes. The threshold amounts for this unearned income, they're going to be the same as our earned income. So $200,000 for single taxpayers and $250,000 for married taxpayers. Now, what is earned income under this surtax? The 3.8 tax is going to apply to interest, dividends, annuities, rents, royalties, capital gains from investment activities, or passive trade or business income. It's not going to include any active trade or business, retirement or IRA distributions, self-employed income, again, active trade or business income. Will not apply to tax-exempt income, and it will not apply to any gains on the sale of an active interest in a partnership or an S corporation. So let's look at a quick example. We're going to look at one taxpayer and give him two different scenarios. So our client is a married couple filing jointly with $260,000 of modified adjusted gross income, and there's going to be a mix of both earned and unearned income. So in scenario one, the earned income is $50,000 and the unearned income is $210,000. The 0.9% Medicare tax on earned income is not going to apply because earned income doesn't exceed the $250,000 threshold. The extra 3.8% Medicare tax will apply to the excess of modified adjusted gross income over $250,000, which in our case is $10,000. So therefore, we have a taxpayer that's going to have an additional tax of $380 in this situation. Now let's look at that same taxpayer, but let's say earned income is $259,000, while unearned income is only $1,000. Now our 0.9% Medicare tax on earned income is going to apply. It's going to be $81, which is the excess of earned income over $250,000, so $9,000 at 0.9%. And the extra 3.8% Medicare tax is going to apply to the $1,000 of unearned income. So our total increase in tax is going to be $119 as a result of the new Health Care Act. The Medicare tax on unearned income, it's very important for taxpayers to really look at whether or not they are real estate tax professionals. Historically, we've really not focused on the real estate tax professionals if these taxpayers are generating income because there was really no impact. The real estate tax professional rules only come into play historically if these taxpayers had losses. Now we're really going to want to look at our clients, and you're going to want to look at your own situation and determine whether or not you're a real estate tax professional. If you do pass the real estate professional test, then your rental income and rental income as a result of these rental properties will be exempt from the 3.8% surtax. If you do not meet these real estate professional tests, then the 3.8 surtax will apply. So what can we do to try to plan for this Medicare tax that's coming into play? Well, obviously, these come into play as AGI exceeds the threshold. So keep your AGI under the threshold. That's step one. The other thing you can do is make a 454B election this year to accelerate all accrued interest on U.S. savings bonds. So report this interest that you're going to be reporting in future years during 2012 when this 3.8% surtax does not apply. Other taxpayers are really reconsidering what their portfolio looks like today, and they're making a shift from income to growth funds to try to shelter from this new tax. And lastly, reconsider municipal bonds. Municipal bonds generate tax-exempt interest, and the Medicare tax on unearned income does not apply to tax-exempt interest. So in addition to the new Medicare taxes that are coming into play, we also have regular tax rate increases coming. So the Bush tax cuts are going to expire after 2012. And what does that mean? In 2013, our 10% bracket is completely eliminated, which really means our 15% bracket is expanded. And our highest marginal rate is going from 35% all the way up to 39.6%. And as you can see, there are tax increases at every tax rate today. So this is going to impact basically everyone. So what can we do? How can we plan for these increases? Well, this is where we're going to take a different stance than our traditional tax planning, and we may consider accelerating income. Taxes are low today based on where current law stands, so it may make more sense for taxpayers to pick up income this year while the tax rates are at their lower rate. The other thing we can do is defer deductions. Next year when tax rates are scheduled to increase, those deductions are going to benefit you more, and they'll provide more tax savings as the tax rates increase. The other thing to do is revisit these Roth IRAs. Again, these Roth IRA conversions are much more appealing this year while the tax rates are so low. And for a lot of taxpayers, there really may not be anything that can be done today, but you can plan your cash flow needs for April 15th of 2013 in anticipation of these higher tax rates. So now we're going to go into another polling question. So the highest ordinary tax rate in 2013 without congressional action and presidential approval is going to be 48%, 15.8%, 39.6%, or 28%, or none of the above. And just 1 minute, this is our last polling question. Another couple seconds to wrap up. Okay, so as we just discussed, the highest ordinary tax rate in 2013 is going to be 39.6%. Okay, so next we're going to see some capital gain tax rate increases as well. So our top marginal tax rates on long-term capital gains, right now we're at 15%, so that's going to be your column all the way on the left. All the way on the right is going to show what happens in 2013 when the tax cuts expire. So our 15% rate today on long-term capital gains is going up to 20%. In addition, we have the 3.8 Medicare tax coming into play. So these taxpayers with long-term capital gains are now going to be subject to a 23.8% tax liability. Now in the middle, we just kind of have a speculative column. What happens if the tax cuts are extended one more year? We're still going to see tax rate increases because that 3.8% Medicare tax is coming into play. So regardless, we're going to see some kind of tax rate increase on January 1st. So what can we do to plan for this? If you are holding appreciated stock, now is the time to sell. If you really like that particular security, the wash sale rules will not apply to any gain transactions. So sell the stock, pay the tax while they're at the lower rates, and go ahead and repurchase that same security. You've now sheltered this tax and kind of reduce your tax liability while maintaining the same position in that stock, and you also have the stock at the new higher basis. If you are planning on selling a business, make sure the deal is closed by December 31st. Some taxpayers really may benefit from electing out of installment sale treatment this year, or reconsider any other tax deferral transactions such as like-kind exchanges. They just may not make sense with the anticipated tax rate increases. Another related topic with this capital gain tax rates, the concept of a dividend being qualified, that's going to be gone at the end of 2012. So now our dividends, which have been, certain dividends have been taxed at 15% over the past several years, they're going to go up to regular tax rates. So you have a top marginal tax rate on dividends that can be as high as 43.4% for some taxpayers. So as you can see, the impact is going to be just substantial. And this is why you're seeing all, Costco and Walmart and all these big companies issuing huge dividends today. They're really trying to shelter this income and reduce the tax liability. All right, the other thing we'll talk about is going to be our payroll tax rates. Right now we have this temporary payroll tax holiday in place. It's at 4.2% of the employee portion. That's going to revert back to 6.2% in 2013. A lot of taxpayers are going to see this as an extension, or see this as a tax increase rather than an extension of a provision that was supposed to be temporary. We have some slides on expired provisions. We're going to pass over this at this point. You can look at these in the slides later. And now Brian's going to do a quick mention of estate tax rates.
And Brian, before you start, I know we're already a little past 2 o'clock, so if those of you that have to leave, you can hang up. We've already asked the last polling question, but we will be wrapping up right after this section. So, Brian, tell us about what's happening in the estate and gift world.
Great, thanks. For 2012, the tax law allows us the potential to pass our heirs at death or via taxable gifts the amount of $5,120,000 without being assessed any federal tax. As you've probably heard in the news lately, if our friends in Washington don't straighten out their act, we'll be left with a drastically different estate tax and gift tax system next year. Without any legislative action, the current 35% tax rate and $5,120,000 exemption reverts back to the 2001 law of $1 million exemption and a tax rate of 55%. That's a huge difference. So with that being said, what can we do before year end? At this late date, probably not too much. For those taxpayers with substantial wealth, they probably will most likely have to cross their fingers and wait for Congress and President Obama to extend the current law or come to some sort of agreement, which as of yesterday wasn't looking very promising. For others, there is and has always been the ability to give annual exclusion gifts. For 2012, the annual exclusion gift was $13,000 for every taxpayer per donee. This enables everyone who has the means to give $13,000 without any tax consequence or eating into that $5,120,000 exemption. If you're married, you can give $26,000 between you and your spouse. This is called gift splitting. How can this help? For example, you have grandma who's married. She has 2 kids and 3 grandkids. By doing annual exclusion gifting before year end, they can get $130,000 out of their estate, which is beneficial. And that's without any real tax planning and estate planning. Other gifting techniques, there are provisions in the law for taxpayers to directly pay the tuition for education or medical expenses of another. For example, let's say your niece is attending college. If you pay her tuition directly to the school, there's no gift tax consequence. It's not even considered part of the annual exclusion gift.
So Brian, if I want to do that, why can't I just write my niece a check and reimburse her for the tuition expense? It's the same result, isn't it?
No, that'd be considered a gift per donee, which you're limited to $13,000 you pay directly to the college. It would be exempt from tax altogether.
So I have to write my check directly to the college to get this benefit.
Correct, and the same rule applies for medical expenses. If you have a relative, or it doesn't have to be a relative, with medical expenses, there's no gifting if you pay the medical expenses directly to the provider.
Okay.
Staying with education, the taxpayer can also fund up to $65,000 to a qualified tuition program for 2012 and make it an election to treat the $65,000 as being ratably paid over 5 years for that one donee, for that one person. The election ultimately allows you to make 5 years of annual exclusion gifts this year. Starting in 2013, the annual exclusion gifts will go up to $14,000 per donee. In conclusion, one thing we don't know is this. One thing we do know is there's no certainty about the future, more specifically next year. Therefore, if possible, and you have the means, it might be a good idea to do some gifting before year end, whether it be the possibility of gifting the whole $5,120,000 of your exemption, or just do an annual exclusion gifting of $13,000 per donee.
Thanks, Brian. And just one backstop to what you said is that all of the talk about gifting, has to start with the proposition as to what makes sense. You could have, more than $5 million, but if you're going to need it, you're not ready to gift it to the next generation, then all of this tax opportunity is really meaningless. You have to do what will let you sleep at night and what makes sense for your own financial plan. So with that, we've come to the end of our conclusion. I want to thank Brian and Lauren for joining us with this webinar. If you have any questions, please feel free to email us at the email addresses you see on the screen. And I'd like to thank you for joining us. Copies of the webinar will be on our webpage at wgcpas.com. And with that, we'd like to say goodbye and have a great day. Thank you.